probably the saddest thing in my life for being a consultant is when a physician suddenly dies or gets sick and is very can't continue on with practice, and then the family and oftentimes the spouse or the children, I've had that happen a number of times, have to rush in and do things at the last minute, and it's really hard. It's sort of hard on the family. So that's why I really like to talk about this subject and the reasons for it.
Welcome to Medical Money Matters, the podcast where you can find experts, answers, and resources so that you can achieve mastery over the financial and business aspects of your practice. Hello, everyone. Welcome to this episode of Medical Money Matters podcast. I am delighted to welcome today Debra Phairas of Practice and Liability Consultants out of the Bay Area. Debra has almost 39 years of experience with healthcare consulting for clients in California and around the country. So I am so excited to talk with Debra today. Debra, welcome.
Well, thank you. I'm delighted to be here too. I always enjoy these podcasts.
Yeah, thank you. We have we've had a little conversation ahead of the podcast today, and I mentioned in looking at Debra's website how many different things she has done for clients over the years, and so we had a fun conversation about what to focus on for today's conversation, and what we came up with was to talk about succession planning for physician and physician owners when they're getting ready to end their practice chapter, whether it's a mid-career shift or a retirement, what that looks like and how best to do the planning for that. So, Debra, I'm excited to hear from you about some of your experiences and some of your considerations that you would suggest for physicians thinking about making a transition in their practice.
Well, yes, as I said, I've worked with over 2,300 practices now, as I always say, of all sizes, shapes, and specialties. And one of the things that I have seen, and I've just been dealing with it this week, so it was on my mind, about doctors planning ahead. First of all, I think that doctors don't do enough strategic planning in their practice, and I certainly always recommend that. So that they can, really think ahead and say, well, what are my 1 or 2 year goals and what are my maybe 5-year goals? And if you're in a group practice, I highly recommend that to get together. It's a great opportunity to kind of solidify the group values and the mission and so forth. But you're really focusing on the strengths, weaknesses, opportunities, and threats, but then action tactics, and then timelines and responsibilities assigned. So, that's what we talk about, like, well, when is everybody going to retire? When is going to everybody leave and things like that? Because we have to plan ahead. Because I don't know about in Oregon, but in California, it is very, very difficult to find physicians that want to come here anymore. It used to be the opposite. We used to have everybody wanting to come here, but now we have, it's very difficult because of the cost of living in many places now. It's interesting because the whole west coast of California all the way down is oversaturated with physicians, but the whole Central Valley and down is undersupplied. So there's still a lot of opportunity there, but certainly it's just one of these things that I, always am talking about. And you and I were chatting about what's probably the saddest thing in my life for being a consultant is when a physician suddenly dies or gets sick and is very can't continue on with practice, and then the family and oftentimes the spouse or the children, I've had that happen a number of times, have to rush in and do things at the last minute, and it's really hard. It's sort of hard on the family. So that's why I really like to talk about this subject and the reasons for it.
That's fantastic. The strategic planning and succession planning, I like to say, especially that kind of thing, planning for, the end of your career, whether it's, a time period that you've called yourself or, as you say, something unfortunate happens. My sense has always been that kind of planning is one of the greatest gifts you can give to your family, is just to have something at least in writing, and it doesn't have to be super detailed, but some general idea of what should happen with the business if something should happen to the owner of the business.
Yes, and that's not even late in the career. I had a physician go rock climbing and pass away who fell off. And then I had another doctor that went skiing in Switzerland and disappeared. And they found him in the spring when the snow melted. He fell down a crevice.
Yeah.
So these are, I mean, I kind of joke in a sad way that, I've seen almost everything now in all these years, and I call it kind of the good, the bad, and the ugly. And, that was certainly those are a couple of the ugliest things, but those were young doctors, and the family had to rush in and try to find things. And in the one case, the doctor had everything pass-coded. Nobody knew the passwords. Nobody knew where the tax returns were. It was really a mess, and that's all I can say. So I think that would be one of the things that I would suggest, and I like what you said, is that doing a loving thing for your family is having a living trust or something like that, and then having everything all kind of laid out. My parents were just lower middle class. My mom was a school secretary, and my dad was an insurance salesman. But she was around all these highly educated people from school, and they had a living trust, I think, when they were about 45 years old. And, when they both, got aged and everything was all laid out. I mean, everything. So it really took a big burden off of my sister and me, in dealing with everything. So that's what I try to tell my physicians. You're absolutely right. A loving thing is to plan for anything that can happen. If you pass away, if you're disabled, and then that has to be in group group practice agreements too, about what happens if you're partially disabled, short-term disability or long-term disability. How does that affect the income distribution formulas? And, another story I have is that I had a plastic surgeon and a facial plastic surgeon that existed on a verbal agreement, which I never recommend. I really believe you should think about all these things and put them in writing. And this facial plastic surgeon had a stroke and became disabled and couldn't come back to work. And the wives had to, try to figure everything out with the remaining physician. And it was all verbal memory about, well, I thought that the tangible assets were going to be valued at replacement cost. No, I thought it was book value. And, all these things about how they were going to buy out the other doctor. Previously great collegial relationships, friends, disintegrated into lawyers going at it. Yeah. So after that experience, that's when I started really talking about, putting everything in writing for when you're bringing in an associate, when you are the road to partnership, how important that is to have that all spelled out, including the approximate value of the practice, so that they can make a good decision. The worst thing you can do about transitioning the practice or bringing in an associate, for example, is like, we'll just come in as an employee and we'll work together for a couple of years and then we'll figure it out. That is a recipe for disaster, as I say. And that can be, I've actually written an article on it. It's called Friend or Foe, Bringing in an Associate. And that's exactly right. Is that, you want to have all this spelled out so that they will join the practice. They will come in as a partner. They will buy you out and not go, oh my God, I never knew that it was going to be this much money. And now I'm going to bail and go set up my own practice, 5 miles down the road or whatever. That's the foe. So, I just feel very strongly about this.
Absolutely. And one of my favorite healthcare attorneys frequently tells our physicians when we're in our physician leadership courses that attorneys are a whole lot less expensive on the front end.
Yes.
And to go ahead and make that investment, get, as you're saying, get those partnership agreements drawn up, pay a few $1,000s to the attorney up front so everybody is crystal clear on what you intend to have happen. And that may not be exactly how it rolls out at the end, but you at least have some guardrails there.
That's what I do, is that I save them a lot of money because I'm, leading them through those decisions. I'm sure you do the same.
Yep.
So that you can take it to the attorney, then they can write it up, or updating your shareholder agreements. That's the same thing. So we're on the same page with that. And I just feel very strongly about that too.
Yeah. Absolutely. Well, I'm sure you've seen it. We've gone into practices where they haven't updated the partnership agreement in 20, 25 years, and people have sort of come and gone in that space, but there's never been any sort of re-examination of it or, sort of modernizing of it to take into account, what the current situation is. So
Yeah, and
How
that's so true
often?
with valuations. That before I forget, I wanted to
Yeah.
mention that because you're exactly right. Is that I've seen that happen. Is that it's 20 years. In fact, I had a client not too long ago. Is that they could not remember the attorney that had originally written up the agreement. Then they finally found and he was long
Long
retired.
retired.
So
Yeah.
and they had never updated it. So that's why I always say that in groups you should really revisit and revote on your shareholder agreement no more than 3 to 5 years,
Yeah.
every 3 to 5
Yeah.
years. So that because valuation things change,
Yeah.
you were chatting about that. The
Yeah.
valuation methodologies, valuations change.
Mhm.
Goodwill goes up and down. And I'm a contributor to the Goodwill Registry. I don't know if you do that or not, but
Oh, yeah.
it's the multiple listing of physician practice sales for us, and
Great.
it's a law firm in Pennsylvania, and those of us that all do valuations, you may want to start contributing to that.
Yeah.
And it's actually the deadline is the end of this month. So I got
Okay.
mine in yesterday. That's why I was thinking about it.
Yeah.
So they compile actual sales and buy-ins and buyouts of practices,
Okay.
and just by region and whether it's urban, suburban, or rural. And they look at what the gross revenues of the practice were. That's all we report. So
Hmm.
it's very confidential. So we just
Yeah.
report that. And then what the sale of the practice was, or the buy-in, and the amount attributed to goodwill. And that's expressed as a percent to revenue of the
Okay.
practice. And that
Yeah.
creates a benchmark. So a lot of us use that as one of the methodologies for valuing a practice, by looking at the Goodwill Registry, and it's different for every specialty. And then that does take into account trends about what is going up or going down. So, for example, dermatology has gone, way up.
Way up. Yeah.
And
Yeah.
then, of course, some, like surgical practices, like maybe general surgery and vascular surgery and those types of things, have gone down.
Yeah.
So it really does create a benchmark. And some of my practices will even use that as evaluation methodology for buy-ins for
Yeah.
practices to say, okay, well, if the Goodwill Registry for X specialty is, let's say it's 22%
Hmm.
as the median to revenue, we will say that we will use the Goodwill Registry for that year, minus maybe we in the Bay Area we always are lower, so minus 5 percentage points or 10 percentage points, but no lower than 10% to gross revenues as
Yeah.
and it makes it really easy then,
Yeah.
because then you put that in the agreement. Okay, we're going to value the accounts receivable at real probable
Yep.
value
Yep.
after adjustments percentage, and a
Hmm.
declining percentage of
Great.
aging a little bit. Tangible assets at usually fair market value, or oftentimes that for buy-ins, I usually recommend used fair market value
Hmm.
for buy-ins
Yeah.
or sale of the practice. But for buyouts between partners, oftentimes we will go with book value for that,
Hmm.
for the reason that the partners have all shared in the depreciation benefit for many years.
Yeah.
So it makes it a little easier for the rest of the group to buy out that physician if it's book value, for example. But
Yeah.
I don't recommend book value on the way in, because a new associate's not coming to the table with, anything usually straight from
Right.
school,
Yeah.
right? Yeah.
That's
So,
fantastic. Could
mhm.
you walk through for our audience a little bit of, we've talked a little bit about when you'd want to use evaluation, but maybe a little bit of how you do those calculations at a high level?
Sure. Well, you need evaluation for many different things, and it's obviously for buy-ins and buyouts. It's for divorce, unfortunately. It's for sometimes insurance purposes, and partnership disputes. I mean, I've been an expert witness in a lot of these cases, so I do that, as well. And I am a believer that evaluation methodologies, I use at least six different methodologies. And I do believe in, like I said, valuing the tangible assets at used fair market value. And it's pretty easy to find all this on the internet or by
Yeah.
vendors right now.
Yeah.
So I go through that, and it's easy to do, because you can, even if I can't come to the practice, you can take a digital picture of every room and just mark down the make and model number, and you can find the value of that very easily.
Yeah.
And then I will also, like I said, value the accounts receivable at looking at the adjustments factor that they've had off of their adjustments, and then apply that to, because, as you know, accounts receivable are carried as billed charges.
Yes.
So that's not
Yeah.
real
Yeah.
money.
Very
So you have
inflated.
to,
Yeah. Yeah.
so you have to discount them by the adjustments factor. And then I also do a little bit of a declining scale for aging.
Sure.
So,
Yeah.
in medicine, though, it's great because we have a really, believe it or not, high collectability than other businesses. So
Yes.
it's not discounted a lot. So that's one methodology. That would be a market comparable for looking at and using the goodwill registry as a percent to revenue. And then, there are many aspects of goodwill. Goodwill, the definition of goodwill is the expectation of profits under new ownership. That's the IRS definition. But there are many things that make up goodwill, and that includes workforce in place, systems, policies, and procedures in place, reputation, referral patterns, trade name, phone number. It's a lot of things. And there are differences about different specialties that you have to know too. So that factors into it too. And then, maybe using the goodwill registry as a starting point and doing plus or minus points for that to come up with a median value and applying that to the gross revenues. That's one methodology. Yeah. There are gross revenue methods. There are companies like BizComps and StatsPrats and things like that. And they actually compile data on actual sales of practices and also create that mean and median factor. And you can use that as a percent to, right now, this past year, about 0.56% to revenue, or 0.56 times revenue was the average for goodwill for many practices. That's to goodwill, to revenues. And then they also calculate seller's discretionary earnings, which is the net income. And that's another percent to net income as well. So there are gross revenue methods, there are net income methods, including capitalization of earnings, excess earnings, and then there's the private equity methods, which is an EBITDA multiple, which is, that's very common in dermatology and plastic surgery and those practices. And then I also use discounted cash flow. It's so important that you look at the trends, and then that you project out revenue, you project out expenses, and, look at the depreciation and the tax bracket, and then you're projecting out, and then it's discounted back to present value. So I like that. I have investment method. There's various methodologies. So I like to use at least 6, and then I do a straight averaging, and then I'll do a weighted average and come up with what I think is the appropriate value. So that's what I like to do for that. And, when it comes to bringing in an associate, I really strongly urge the doctors to try to figure out what's an approximate value of the practice using these methodologies or something else, and try to present that to them. Like, if you're offered partnership, which I would never recommend that you offer partnership anything less than 1 year of working in the practice, because doctors have to get to know each other, see if they're going to be compatible. You have to find out if this is actually, this doctor is partner material. So one of the tips that I have always urged my doctors to do when they're bringing in an associate is, especially when they're an employee, is tell them that, they're being evaluated towards eventual partnership, and that they need to do things to help build their own practice, not just sit back and wait for the senior doctor to make it happen. So I will suggest that they submit 3-month marketing activities to the senior physician. Like, what have you done to build your practice? It could be things like contacting the radio and TV stations about your specialty. And certainly if the doctor has a language, like, for example, one of my clients spoke Mandarin, and she contacted all the Mandarin stations and just completely was on those television stations and radio stations for people who spoke her language. And then they would come into the practice to see her because they knew she spoke Mandarin. So, those are really great things to do to try to build your practice and to show that your partnership material, as well as taking on some practice duties to show interest in the business side of the practice. As we all know, doctors don't like that much, but that's really showing that you're a good partner material when you're doing that. Yeah. So if you're going to bring in an associate, I really highly recommend that you spell out, what is all the compensation, when and how salary is paid, benefits, hours, days of the week, surgery, procedure times, all those types of things. And, clearly put that out in an employment offer. Mm-hmm. And then you should also tell them in writing, should you be offered partnership and to become into the partner, like in a year or 2 years, this would be the methodology that we'll use for the valuation. This would be the approximate if it was going to happen today, so that they're fully aware of everything to make a good decision. Because the last thing, like I said, you don't want that doctor to be an employee for 2 years, then be hit with this $1 million buy-in, and they're going to say, I had no idea that this was going to be this much. I can't do that. I don't want to do that. I would have never joined this practice had I known that. You should have told me that. So that's really what I recommend. And really looking at really a good confident attitude, ability to go out and market themselves. One of the things that I suggest to doctors to build their referral source is go visit them and say, I'm just new in practice. I want to be a partner. I want to buy into this practice, and I want to build my practice. How did you do it? And then you're getting that doctor talking about himself or herself rather than you trying to sell yourself. And then just say, thanks. Those were great ideas. I really appreciate it. And then if I'm lucky enough to get your referrals, how would you like them to be handled? Would you like me to text you, call you, write you, fax you? What is it that you want from me? Put it in Epic or whatever it might be. Yeah. And I will do what you want me to do, because those referring doctors are that specialist customers, just like their patients are. Right. So that helps really delve into all that. And then I think that you need to decide about what's tail insurance. That's always missed, it seems like. Who's going to be responsible for the tail if you're bringing in an associate? Is it going to be the associate? Is it going to be the practice? Are you going to split it 50-50? And then you really have to make sure that you clearly state that all accounts receivable charts, good, lists, practice, trade secrets are property of the senior doctor, and they are not to be taken. Yeah. So another thing you need to find out is restrictive covenants in your state. Are they legal or not? So for example, in California, restrictive covenants are not legal for employee-employer relationships. So the employer cannot invoke a restrictive covenant on that new employee. However, if that new employee becomes a partner in the business and an owner, then they are allowable, and it has to be reasonable. It has to be usually 1 to 3 years, and pretty much the draw radius of the practice. So it can't be the whole state. Yeah, and it'd be interesting to know if you know what your restrictive covenant ordinances are in Oregon or other states. You can find out from contacting your state medical association. Yeah. So that's the good news. And then, create an incentive program. I like to do this with employee physicians, nurse practitioners, and PAs, is that I will try to figure out, and it's really easy to do on a spreadsheet, is that figure out what their direct costs are for their salary, their benefits, anything direct benefits that you're going to provide for them, because that gives you your total direct cost. Yeah. Then you have to know what your true operating overhead ratio is. So you have to take out what the doctor's salary is, and doctor benefits, and probably travel and entertainment and auto for the doctor. And then you'll get your true operating overhead ratio. And then you are going to subtract that from 100%, and that will be your divisor that you divide into the direct costs, and that will give you the break even of what that doctor needs to bring in to pay for himself or herself with operating overhead and also their direct costs. And then you'll get that break even. So maybe it's going to be, let's say it's $500,000 for the break even. And then we'll make it easy. Say you had a 50% overhead ratio. So anything over $500,000 that doctor brings in, like say it's another 20,000 that they bring in that first year, then that's $20,000. The first 50% or 10,000 has to go to increased overhead. But then you have 10,000 that you can play with a bonus. And I would suggest in that case that perhaps the seller take a 25% return on investment or $2,500, and then 25% goes to the associate or the nurse practitioner or the PA. So another 25%, let's say I did that, 5,000. It would be 5,000, 5,000, and 10,000, excuse me. So $5,000 to the owner and $5,000 for the associate. So then you've covered your costs. You've covered your direct costs. You've covered your contribution to overhead. The owner gets a return on investment, and the employee, doctor, PA, or nurse practitioner gets an incentive bonus. You have to do this to make sure that they know what's expected of them to bring in terms of collections. Too frequently, I find that doctors don't do this, and then they don't even know if they're making money or losing money on their associates, their physician assistants, or their nurse practitioners. So that's what I think are really important things about bringing in an associate. And I think that that's, really talking about that, the road to partnership. I actually also believe in calculating goodwill, or that aspect of the practice buy-in, to the time that the doctor came into the practice, because thereafter the doctor is building revenues and contributing to goodwill. So I think it's a little bit of double dipping to charge them out 2 years down the road. That's just my personal feeling. Yeah. But again, I work with my doctors to see, how do you feel about these things? So those are some of the things that I think are really important. And I can't stress enough my watchwords for bringing in an associate, bringing in anybody into the practice is that the road to successful partnerships is transparency, having this all decided up front. And I call it then having the courage to communicate, confront, and compromise with your new associate, your potential partner, any of those types of people. Yeah. So that's what I think is a good way to go about things. Anything else that you'd like to discuss today? Or like me to discuss?
Yes, I would love to hear your thoughts if physicians are preparing to sell their practice. You and I had talked a little bit earlier about the distinction between finding another associate, which we've just covered beautifully, thank you, perhaps selling to a hospital or perhaps selling to private equity, and what would be some of the considerations you'd have for them in those scenarios?
Oh, I'd also like to bring up one other thing, is that I think that what I've seen is that, and it's just a generalization, but I have seen that male physicians have a little bit harder time retiring than female physicians. And I think the female physicians want to spend time with their grandkids, their friends, they have hobbies, they have interests. And a lot of my male physicians, medicine was their life, and they don't always have the older physicians. The younger physicians all about work-life balance now, but the older physicians, they didn't have a lot of hobbies. And I've had doctors work too long and actually get to the point of a little bit of dementia. And that is always a very different thing. And that is very difficult. And so I urge everyone to have good hobbies, interests, so you can retire when you're ready and able to retire, and you can enjoy those retirement years. And I also want to talk about what is it about selling to just selling your practice to another physician. If you can't bring in an associate and you just want to sell to another doctor, then there's a lot of ways to go about that. Generally getting evaluation, and then approaching other doctors in the community. And you have to approach more than one so that they don't think that they're going to be the only one that you're going to sell to, and just, get a confidentiality NDA agreement and say, I'm going to offer this to several physicians, but I also wanted to offer it to you. It must remain confidential for this point. And then, try to work with them and maybe work 2 or 3 doctors off of each other. That's the best scenario. And oftentimes, I know it's very difficult for physicians to do that, especially if it's a colleague. So that's when you might want to have a broker involved that can take that off of you. And that's a obviously a good thing to do. And you'll pay a percentage to the practice sale. Generally, it's higher than a real estate. It's usually 10%. And oftentimes, if you find the buyer, then many of the brokers will discount that to 5%. So that's a good thing. But they can handle escrow, which is good. They can write the contract to sale. So generally, in most states, you can sell your practice yourself for sale by owner, just like you could do that with your house, an attorney, or a real estate broker. And then sometimes consultants can do that too. It depends on the state. So that's another thing. And you want to get some maybe earnest money down, and maybe that will be refundable or non-refundable. That's all up to you. And then you have to make sure that as a physician, one of the important elements of a contract of sale is that the seller has to have the buyer retain the medical records, if it's electronic or paper, for as long as the malpractice carrier wants them to be retained. Mm-hmm. Everybody thinks it's 7 years. That's hospital. But you need to contact your own malpractice carrier and ask, how long do I need to have my records retained? Because your chart is your best defense weapon in a professional liability claim. And so I'm a former risk manager for a med-mal company, so I'm very well versed on this. Yeah. So that's an important aspect to write in the contract of sale, as how long that the buyer has to retain the medical charts. Critically important. The other thing that you want to, and then the seller has a right to come in and take those back in the event of a professional liability claim, make a copy, whatever it may be. So that's really an important thing to write in the contract of sale. That's probably the most important thing that you want to do. Now, if you can't, if you can't sell your practice and you're just going to give up your records, maybe you can find another physician that will take them, and you have to have a written custodian of records agreement with the same premise that they're going to retain those records as long as the malpractice carrier wants them retained. And then sometimes there are companies that will retain those records for you, storage companies, and they'll charge a fee for copying them and things like that. Yeah. So that's really an important thing. And then probably the last thing that I want to talk about is private equity. And I've been doing this for so many years. So I remember the first go around of private equity in the late 90s and the 2000s. And, it was there for a while, and it was mostly primary care at that point. And it pretty much crashed and burned after a bit. Now it's different a little bit. And there's a lot of private equity companies coming into this. Just today, I was reviewing, I'm on a board of for physicians, and I was reviewing a possible law that has a lot to do with private equity in California. So we may be a first on the line to kind of regulate a little bit of private equity with physician purchases. So we'll see what happens. It's only infancy stages right now. But one of the things that was noted in there is the restrictive covenant. They want to not make it, if the doctor is let go or terminated and things like that, that the entity cannot invoke a restrictive covenant. So here in California, I've had some dermatologists sign contracts with private equity that require them to have a 200-mile restrictive covenant, which isn't even legal, but then you have to try to fight it. So that will be very important, and I hope that will be a part of this bill. So the other thing that I think is so important for physicians, because they kind of see stars in their eyes when they hear, oh, I'm going to get them $2 million for this practice, or $1 million. Well, you have to go through the math, and I know you're all really good at math. So get on a spreadsheet and do the math about, okay, if they give you $2 million, are you going to lose 37% in taxes right off the bat? Okay, that might be. So that's going to lower the amount of money. Sometimes they want to give you stock and so forth. And, some of my doctors are like, oh, I'm going to get stock, and the stock's doing really well right now. Well, is it always a guarantee that stock is going to go up and up and up? No, it could crash, for bad management and other types of things. Yeah. So stock is not a sure thing. So my advice usually is get more of it on, money up front, or, over several years that you're getting actually cold hard cash, not, in stock necessarily. And then you have to do the math to say, okay, I did this with a dermatologist. She was making a little over $800 and some thousand. in all that she took out of the practice. And that includes some benefits like her travel and entertainment and things like that. So what they were going to give her was, again, a couple $1 million or $1.5 million, I think it was. And she was going to lose some of that. And then they were going to bring her down to what's the fair market salary for the specialty, which is around $400,000. So, there's a delta there of $400,000, and they want you to work for 3 or 5 years. Well, that's going to be, a pretty significant amount of money that you could have had. Right. And plus you don't get to run through your travel, entertainment, all those types of things. So you have to add up all the benefits that you're taking out of the practice to see if it's going to be a good deal or not. Some are good deals. I think that private equity isn't a bad retirement strategy. If you only have 2 or 3 years left in the practice and you can't sell that practice, well, this is a godsend. And I was chatting with Jody about this, is that this one doctor was offered $750,000 by Optum, which I also have some concerns about, but that was a pretty good value for her family practice. But she was also insistent that they find a Vietnamese speaking doctor because she felt very, cared about her patients having a Vietnamese speaking doctor. They couldn't find one, couldn't find a PA that spoke that. And they also wanted her to learn electronic records at the end of her career, which she was not excited about in the least. So she ended up, they both parted ways, and she ended up selling it to another physician who was a Vietnamese speaking physician for around $400,000, something like that. So, you have to weigh that. And I usually say it's not a bad strategy for somebody that's 2 or 3 years out. It's a medium strategy for somebody that has maybe 5 to 10 years of practice. And I think it's a pretty bad strategy if you have more than 10 years of practice, because you could probably make more doing it yourself or joining a group or building a group, for example, than selling to private equity. And there's a lot of control issues. So one of the things that is in this new bill is that if the private equity, if it goes through, this is not anything that's for sure yet, but they would have to talk or present that to the Attorney General of California if then that private equity is going to sell to another private equity, because that's generally their strategy. They want to make a return on their investment in 3 to 5 years. Then they're going to look for a buyer and turn it and sell it to somebody else. And every time they turn this, the doctors get squeezed usually, and the administrators. So I've seen the doctors have to ramp up the productivity a lot. And then the administrator who is maybe supervising one practice now has to supervise 3 or 4 in that geographic area so that they can save on administrative costs. So you just have to know what the entire deal is and think, down the road, maybe 2 or 3 years. So, those are kind of the strategies for planning. You can either, bring in an associate, try to build them towards partnership. So you have a buyout, making sure you can merge. I forgot about that. You can merge with another similar group, and then that would provide a good buyout and succession strategy. If you're all a bunch of, I merged 6 solo otolaryngology practices. And now they're a great group, and it's been so nice because as people come and go, it's not a big deal, as opposed to if you're trying to just do one solo doctor, that's very difficult. So bringing in an associate, merging the practice, outright selling the practice to a hospital, for example. I believe in Oregon, you can actually sell to a hospital directly. You can't in California. That's they have to have a foundation model. It's a different structure. It's almost the same. But in any case, that would be another thing. And oftentimes for a hospital, for example, they don't always pay for goodwill. So that is another factor. They might give you a higher salary to compensate, but they don't always pay for goodwill. And universities oftentimes are also acquiring practices too. So that's another option. Optum and insurance companies are coming into the market and consolidating practices and purchasing them, and then private equity. So those are all the strategies that you have for succession planning, and then just growing your practice too. It's not just succession planning. It's not just succession planning. It's also growing and making a bigger practice. I have a doctor who is actively bringing in several different specialties in her, some subspecialties in her specialty, because her end goal is that she wants to retire in about 7 years, around 7 years. And she doesn't think they're going to buy into the practice because there's a lot of real estate and so forth. It's a separate entity, but she's hopeful that a private equity will buy her out. So there's many strategies, but my advice is just think of something and plan for it with your strategic planning, plan with your other partners, revisit and revote on. It doesn't mean you have to change everything, but your buy-sell formula and probably your income distribution formula in your partnership or shareholder agreement every 3 to 5 years, so that when you're ready and you really want to leave the practice, you're going to be able to do so, and it's going to be smooth, and it's not going to be a big argument with your other partners, or you're panicking because you can't transition this practice. You will have thoughtfully thought this all through and planned for it, from maybe years out. So that's what I have to say today. Is there any other follow-up comments that you'd like me to make?
That's wonderful, Debra. Thank you so much for being with us today. It's been a real pleasure. Thank you. You can find more information online at medicalmoneymatterspodcast.com, and you can also find examples in my book, Physician Heal Thy Financial Self, which is available on Amazon. We've included those links in the show notes. As I like to close out these podcasts, congratulations on taking the next step in your professional development and for making the commitment to learn about the financial and business aspects of your practice. I look forward to being on this journey with you, and I send you my heartfelt gratitude for all that you do for your patients all day, every day.